Building wealth, a tale of two strategies, investing. It's a word that can evoke excitement and anxiety all at once. The idea of growing your money and securing your financial future is enticing, but the world of investing can seem complex and intimidating. Don't worry, we'll break it down for you. At its core, investing is about putting your money to work for you. It's about making your money grow so you can achieve your financial goals, whether buying a house, retiring comfortably, or leaving a legacy for your loved ones. But there are different approaches to investing, each with its own set of advantages and disadvantages. In this essay, we'll explore two fundamental investment strategies: long-term investing and short-term investing. Think of them as two different paths leading to the same destination: financial success. We'll delve into the benefits and drawbacks of each approach. We'll also discuss how to determine which strategy aligns best with your financial goals, risk tolerance, and time commitment. By the end of this essay, you'll have a clearer understanding of long-term and short-term investing. You'll be empowered to make informed decisions about how to make your money work harder for you. Remember, investing isn't about getting rich quick. It's about building wealth steadily and securely over time. The long game: understanding long-term investing. Long-term investing is like planting a tree and watching it grow into a mighty oak. It's about patience, consistency, and reaping the rewards of time. This strategy involves investing your money in assets like stocks, bonds, or real estate for an extended period, typically 5 years or more. The beauty of long-term investing lies in its ability to weather market fluctuations. The financial market is like a roller coaster, with its share of ups and downs. Over short periods, the market can be volatile, experiencing sudden drops and surges. However, over the long term, the market tends to trend upwards. Long-term investors ride out these short-term fluctuations, keeping their eyes on the distant horizon. They understand that market downturns are a natural part of the cycle. Instead of panicking and selling their investments when the market dips, they hold steady, knowing that the market will eventually recover. This approach requires discipline and a long-term perspective. It's not about trying to time the market or make a quick buck. It's about steadily growing your wealth over time by giving your investments the opportunity to appreciate in value. The power of compounding: your money's snowball effect. One of the most compelling reasons to embrace long-term investing is the magic of compound growth. Compounding is like a snowball effect for your money. It's the principle of earning interest on your initial investment and then earning interest on your accumulated interest. Imagine you invest $1,000 today, and it earns a 10% return in the first year. You now have $1,100. In the second year, you earn a 10% return on $1,100, not just your initial $1,000. This compounding effect continues year after year, with your earnings building upon previous earnings. Over time, compounding can lead to exponential growth in your investments. The longer you invest, the more powerful the compounding effect becomes. This is why starting early is crucial. Even small contributions invested consistently over time can grow into a substantial nest egg. Let's say you start investing $100 a month at age 25 with an average annual return of 7%. By age 65, you'd have over $240,000. Now imagine starting at age 35, you'd only accumulate around $100,000. That's the power of compounding. Riding the waves: navigating short-term investing. Short-term investing is like riding the waves on a surfboard. It's fast-paced, exhilarating, and requires skill and agility to navigate the ups and downs. This strategy involves buying and selling assets over short periods, from a few days to a few months, aiming to profit from short-term market fluctuations. Short-term investors are like market surfers, constantly scanning the horizon for the next big wave. They look for opportunities to buy low and sell high, capitalizing on market volatility to generate quick profits. This approach requires constant monitoring of the market, quick decision-making, and a high tolerance for risk. Short-term investing isn't for the faint of heart. It's a high-risk, high-reward game that demands a deep understanding of market dynamics, technical analysis, and a cool head under pressure. While the potential for quick profits is alluring, it comes with the risk of significant losses. Short-term traders often use strategies like day trading, swing trading, or scalping, each with its own set of rules and techniques. These strategies require specialized knowledge and a significant time commitment to master. Section 5. The thrill and the risk, short-term investing's highs and lows. Short-term investing can be an adrenaline-pumping ride, offering the potential for substantial gains in a short period. Successful short-term traders often possess a deep understanding of market trends, technical indicators, and risk management strategies. They thrive on the challenge of identifying profitable trading opportunities and executing trades with precision and speed. The ability to make quick decisions based on market data and adapt to changing conditions is crucial in the fast-paced world of short-term investing. However, it's important to remember that short-term investing is inherently risky. The market can be unpredictable, and even experienced traders can experience losses. Factors like economic news, geopolitical events, and even social media sentiment can significantly impact market movements, making it challenging to predict short-term price fluctuations. Furthermore, short-term trading can be time-consuming and emotionally draining. It requires constant monitoring of the market, analyzing charts, and executing trades, often under pressure. The emotional toll of dealing with potential losses and the constant need to stay ahead of the curve can be significant. Section 6. Time is money. Your investment timeline matters. When choosing between long-term and short-term investing, one crucial factor to consider is your investment timeline. How long do you plan to keep your money invested before you need to access it? If you're investing for a long-term goal like retirement, buying a house, or funding your child's education, a long-term investment strategy is generally more suitable. Long-term investing allows you to ride out market fluctuations and benefit from the power of compounding over time. On the other hand, if you have a shorter time horizon, such as saving for a down payment on a car or a dream vacation within the next year or two, short-term investing might be more appropriate. However, it's essential to remember the higher risk involved and the potential for losses. Your investment timeline is a critical factor in determining your risk tolerance. The longer your time horizon, the more risk you can afford to take because you have more time to recover from potential losses. Conversely, if you have a shorter time horizon, you'll need to be more conservative with your investments to minimize the risk of losing your principal. Section 7. From timid to daring, assessing your risk appetite. Risk tolerance is another crucial factor to consider when choosing between long-term and short-term investing. Risk tolerance refers to your ability to stomach market fluctuations and potential losses without panicking or making rash decisions. Some investors are naturally risk-averse. They prefer investments with lower potential returns but also lower risk. They're comfortable with slow and steady growth and prioritize the preservation of their capital. Long-term investing in more conservative assets like bonds or index funds might be a good fit for these investors. Other investors have a higher risk appetite. They're comfortable with the idea of taking on more risk for the potential of higher returns. They're not afraid of market volatility and are willing to ride out the ups and downs. Short-term investing or investing in more volatile assets like growth stocks or emerging markets might be more appealing to these investors. It's important to be honest with yourself about your risk tolerance. Don't try to be someone you're not. If you're constantly worried about your investments or lose sleep over market fluctuations, you're probably taking on too much risk. Section 8. Finding your fit. Choosing the right investment strategy. Choosing the right investment strategy is a personal decision based on your financial goals, risk tolerance, time horizon, and investment knowledge. There's no one-size-fits-all approach. If you're new to investing, starting with a long-term investment strategy and low-cost index funds or ETFs that track the broader market is a good approach. This allows you to participate in market growth without needing to pick individual stocks or time the market. As you gain more experience and knowledge, you can explore other investment options like individual stocks, bonds, real estate, or even short-term trading strategies. However, it's crucial to do your research, understand the risks involved, and never invest more than you can afford to lose. Remember, investing isn't a get-rich-quick scheme. It's about building wealth steadily and securely over time. It's about making your money work for you so you can achieve your financial goals and live the life you desire.